Hi, everybody. Welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode 127, we're going to continue our series on estate planning calculations. This will be part 3, where we're going to dive into adjustment factors that might be applied based on the frequency of payments of annuities and unitrusts from a trust. So where we apply this, to remind you again, is where we're calculating the value, maybe the present interest of an annuity or unitrust that might be payable for life or over a term of years. And what this class today is dedicated to is the fact that when payments are received more frequently than annually, you may have to adjust some of the factors that go into that ultimate present value calculation. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, if you want to go back and look at more of the calculations series, I refer you back to episode 108, where we talked about just simple life estates and income interests that are calculated over a single life or over a term of years. That was a fairly simple calculation. We stepped up a little bit in complexity in episode 116, where we calculated a single life annuity. And as a natural continuation of the calculation of a single life annuity, as we left off, we looked at the fact that you may have to adjust certain factors when the annuity is payable more frequently than annually. So today is all about the adjustment factors that go into an annuity or unitrust calculation. Then in the future, we'll look at more examples and explanations, as I promised, and we'll dig more into unitrust valuations for present value and remainder interest, and also dig into second to die and first to die valuations and more. So there's lots of things to come on the horizon, but we're going to continue talking about estate planning calculations. Now, as I mentioned, the significance of adjustment factors tie into the fact that most IRS tables start from a baseline assuming that an annuity or unitrust will be payable annually. However, it's often the case that payments occur more frequently than annually, such as maybe semi-annually or quarterly or monthly, whatever the case might be. So in that case, you have to adjust essentially the assumed value of that annuity payment annually or unitrust payment by percent to take into account that increased frequency over annual distributions. Now, first, we're going to look at annuity factors. So, as we talked about in the last class, for term certain annuities and for life annuities, you use Table B and Table S respectively to find an annuity factor that will be used to calculate the present value of that annuity. And that's based on the 75/20 rate at the time of calculation and based on the age of the annuitant if it's a lifetime annuity. So this factor represents the present value of an annuity of $1 payable annually. So for example, in Table S below, you see I've circled in red the annuity factors for ages 55, 56, and 57. Each of those represent the value of $1 payable annually today, whether you're at age 55, 56, or 57 respectively. Now typically that would just simply give you the present value of the annuity, but since that factor is based on an annual payment, you have to further adjust it to take into account the frequency of payment. So you have to take an adjustment factor from IRS Table K based on the 75/20 rate at the inception of the trust. So as we see below, you start off with a 1 factor, a factor of 1 for annual payments, so there's no adjustment needed there. But if you move up to semi-annually, quarterly, or monthly payments, you can see that essentially increases the present value of the annuity based on that increased frequency. So I'm going to circle the quarterly just because that's the most routine one I've mentioned, and I want you to take note of the 0.4% quarterly payment adjustment of 1.0015. So we're going to use that. We're going to say that based on Table S, with a 75/20 rate of 0.4%, the present value of an annuity of $1 per year payable annually starting at age 55 would be $24.07 and change, as we saw back here in Table S. But if that's payable quarterly, we have to multiply that $24 figure by the adjustment factor of 1.0015 we saw for the 0.4% interest rate under Table K. And in that case, that increases the present value of that annuity to $27.11. And the significance of this is that that ties into that present value calculation as we just saw. So essentially we'd multiply that 27.112 factor times whatever the annual annuity payment is to determine essentially its present value. Now, when it comes to a Unitrust, we don't necessarily adjust the present value in dollar figures of the Unitrust paid, because the Unitrust is going to be an annual distribution based on a percent of the value of the trust. That's the payout percentage. And that's not determined by an IRS table. That's really determined by the grantor up front when the trust is created. So what happens is that payout percentage every single year is applied to the value of the trust, typically at the close of the preceding tax year, and that will tell you your annual Unitrust distribution for the current year. So for example, let's assume that a grantor drafted a Unitrust with an 8% payout percentage. Remember again, that 8% isn't based on an IRS table, it's pulled out of thin air. So let's assume further that the value of the trust as of December 31 of last year was $1 million. So that $1 million is going to form the basis of the value for our distributions in 2021. And with an 8% payout on that million, that means $80,000 will have to be distributed in 2021. That'll be your annual distribution. However, if the $80,000 is to be distributed more frequently than annually under the trust, the calculations of present value or remainder interest of that Unitrust must take into account an adjusted payout rate. So we're going to adjust that 8% payout rate by a factor. So where those factors are determined is under IRS Table F, which is based on the 75/20 rate, not for the year of valuation, but for the year that the trust was created. And you also have to figure out the number of months that separate the date of valuation and the first payment. So for example, if you had a quarterly payment, it would be paid 3 months into the year. And that means 3 months at least would separate the 12/31 valuation date and the first quarterly distribution. So you see I've circled the quarterly distributions, and really what we're going to be concerned with is the last on that list, the last factor, which will be at least 3 but not more than 4 months that elapse between valuation and distribution. That'll be your adjusted payout percentage. You'll take that factor and multiply it by 8% to get your adjusted Unitrust payout rate. And really, remember again that this is used not for purposes of calculating the actual Unitrust payout every single year, but instead is used for purposes of calculating the present value or the remainder interest. We'll talk about that later, but for the time being, as you see by our formula below, we use the 8% payout from the trust times the adjustment factor for quarterly payments, which is 0.997509, and that gives us an adjusted Unitrust payout rate of 7.98% and change. So once again, what's the significance of the Unitrust factor? It's going to be used to calculate the present value of the Unitrust or remainder amounts. But it's a complicated calculation. That'll be a subject for another time. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of The 10th of an Hour, and I look forward to seeing you in the next one.